Hey guys, welcome to It's Possible. I'm Opal, and today we're going to be talking some more about mortgages, and we're going to be talking about the pre-approval process to mortgages. And I'm going to be zooming in on something that is not spoken about often enough. We're going to be talking about debt service ratio and how does debt service ratio impact your ability to actually qualify for a mortgage. So, what is debt service ratio? Debt service ratio is the total of all your expenses, meaning your light bill, water bill, any expenses regarding your food, car payments, credit card, and the potential mortgage that you're going to pay. All of those expenses divided by your gross income, that is your income before tax. So, what most institutions are looking at is when they work out your debt service ratio, is enough money left for you to do other things? Is it too high that will result in you not being able to honor your mortgage? And so you have to ensure that as much as possible going into a mortgage, you reduce your expenses. Every financial institution is going to have a different debt service ratio requirement. One institution may have 40%, another institution may have 50%, another institution may have 30%. It is important that you understand by speaking to the financial institution what is the required debt service ratio for a mortgage or for any loan for that matter. So, how does a debt service ratio affect your ability to qualify for a mortgage? Of course, if it's too high, it's going to affect your ability to get the mortgage, right? Or to borrow a certain amount of money from the institution for the mortgage. So, you want to ensure that as much as possible, you're reducing your debt service ratio. Now, you have to understand that what affects your debt service ratio is not just things that appear on your pay slip. So let's say, for example, you have children, you also have to make it known to the bank what is your monthly expenses like for your kids, right? If you have a commitment that you are covering for, let's say, a student loan for a family member, may not be on your actual pay slip, but it's a commitment there, and if they find out about it, of course, through credit check, it's going to impact your debt service ratio. So you have to ensure that all those things you consider when you are actually looking at, will I be able to afford this mortgage based on what it is that I want and the monthly payment that is required of me. So let's get into an actual calculation. Let me show you how to quickly calculate your debt service ratio. All right, so here we have a spreadsheet, and this is for an individual who has a gross income of 150,000. So before tax, you're making 150,000. And for the month, the utilities are 13,000, credit card 8,000, car loan 15,000, food 25, mortgage 50,000. Now when we total all of these expenses, we get $111,000, and your income is $150,000. So your debt service ratio is calculated as dividing your total expenses divided by the income, right? And we times that by 100. So the debt service ratio for someone who has this amount of expense with this amount of income before tax would be 74%, right? Of course, as I said before, different institutions are going to differ based on their requirement for the debt service ratio. So how do you improve on your debt service ratio? Simple. Reduce your debt. If you have a debt service ratio that is too high and the bank is saying, hey, we can't give you this mortgage because your debt service ratio, your total debt service ratio is too high, then it means all you need to do is to reduce your debt. So simple things you can do: if you have credit cards, you can pay them off and cancel them. right? If you owe $0 on your credit card and you still have it active, it still impacts your debt service ratio, because they're still going to do an assessment on average what you would have to pay in case you use the card. So you would have to remove that card completely from your credit history in terms of paying it off before it can be removed as a part of your calculation. If you have any quick consumer loans that you can start paying off, pay them off quickly. Once you get your debt down, then of course that affects your affordability, and that makes you more attractive to the financial institution in terms of lending you money. Because at the end of the day, no financial entity wants to lend you money with a heavy debt service ratio that could potentially mean that just in case there's anything out of the norm happening in your life, you're going to default on that loan because you have to take care of an emergency. So there's not even enough money left for you to create an emergency fund or have a little money stuck away, because all of your money is going into your expenses. And that is what the financial institution wants to safeguard itself against. When we lend you money, you have enough space, enough leeway in your budget to pay us back even if you have an emergency. And so that's it for today, guys. Thanks for tuning in. And if this video was useful to you, please go ahead and like and subscribe, and look out for more tips on It's Possible, where we're building wealth. We're making all things possible. Home ownership, everything you can imagine, it's possible and it is within your reach. See you again next week.